Most investors have heard the buzz around Bitcoin, but few truly understand what it is, how it works, or where it fits into a serious portfolio. Today, we're lucky to be sitting down with Jack Manley, Executive Director and Global Market Strategist at jpmorgan Asset Management, to unpack what's really behind the headlines and what role, if any, cryptocurrency should play in a diversified investment strategy. Hey there, I'm David Drummond, founding partner at DLD Financial Group. I've been in the business since 1999 and I'm a certified financial planner. Joining me today is my longtime business partner and co-host Kelly Ho, also a CFP and certified cash flow specialist. Let's get into it.
Kelly and I are very excited today to have a special guest, Jack Manley, Executive Director. He's a global market strategist at jpmorgan Asset Management. Jack is responsible for delivering timely market and economic commentary to institutional and retail clients across the United States and Canada. In addition, he is a contributor to the JP Morgan Long-Term Capital Market Assumptions and has authored numerous papers on both global and domestic economies and capital markets. Jack is also a frequent guest on CNBC, Bloomberg, BNN, and other financial news outlets, and is often quoted in the financial press. He graduated from the University of Chicago with a bachelor's degree in history. Jack joined JP Morgan in 2013 as a member of the Asset Management Strategy and Business Development team, where he worked on various strategic initiatives across the firm. And he's been in his current role since 2016. Thanks so much for coming on the channel, Jack.
Yeah, thank you very much, Dave and Kelly. It's really good to be here.
Good stuff. So, we're pretty excited to have this discussion. So many people have so many questions about Bitcoin. And so we've tried to put together a list of subjects that we commonly get questions on from clients. So we thought we'd start with the big one, which is, what is Bitcoin? What is the appeal? And how does it fit into a portfolio?
Yeah, it's a good place to start on a very big and sort of open-ended conversation that I've certainly been having a lot with investors really all across the U.S. and Canada, which is cryptocurrency, right? Like, what is this stuff? What role does it play? How do we think about it? And I think even the way you asked the question there, Dave, helps to sort of inform the way that the conversation goes, which is that when people think about crypto, they typically speaking think about Bitcoin. And when people think about Bitcoin, they typically speaking think about crypto. They sort of use these terms interchangeably. And I would say there's a pretty good reason for that, right? It's not crazy that we use Bitcoin to mean crypto. We use crypto to mean Bitcoin. Bitcoin, I would say, first of all, is the original cryptocurrency. You're talking about first mover advantage in this space. It's been around for about 15 years at this point. So for those of us that learned about crypto 10, 12, 15 years ago, you are learning about Bitcoin. So the fact that it's had that kind of staying power in popular culture, I think, makes a lot of sense. Bitcoin is also the largest cryptocurrency by market capitalization. Sort of at any point in time, Bitcoin is between 60 and 70% of the entire crypto universe from a market cap perspective. So it's the biggest by a very wide margin. And then finally, right, Bitcoin is probably the most valuable, quote unquote, cryptocurrency. At least when you think about what it's priced in terms of dollars, right? I mean, well north of $100,000 per coin when it comes to the Bitcoin market. And you turn on television and you'll see a chart that looks at its extraordinary price performance. All this money that people have made in this space. I mean, it's impossible to look away, and that's why Bitcoin has become such a focus for individuals that are thinking about kind of the next frontier of finance and thinking about cryptocurrency more broadly. Now, what is Bitcoin? Bitcoin is ultimately meant to be a replacement for a fiat currency. And a fiat currency is like the Canadian dollar or the US dollar or the euro or the yen, right? It is the currency that we transact in, day out. But the appeal of Bitcoin, I would say, is multi-layered, right? I mean, one of the things that is so appealing about Bitcoin is that it is decentralized in the sense that, like, there is no central bank, There is no treasury. There is no governmental organization that is dictating the underlying dynamics of what happens with this particular currency, right? It's different from the CAD or the USD or the euro or the yen, and that there is a centralized authority that goes out and mints that thing and sets rules and regulations. It's not really the way it works for cryptocurrency, and that's not the way that it works for Bitcoin. So that's one reason why people like it. People also like it because it is quite secure and stable, and that's through the nature of its infrastructure, the sort of blockchain technology. It's stable, it's secure, it's hard to hack into, it's hard to lose your currency, so that's appealing. And perhaps the most appealing thing about Bitcoin is that unlike a fiat currency, unlike a dollar or a euro or a yen, there is a finite amount of Bitcoin that will ever be in existence. 21 million Bitcoin. That is the cap. There will never be any more Bitcoin than 21 million entered into circulation. And interestingly enough, if you think about where we are right now, I think like 19 and change have been minted so far, which means we're almost at the tail end of like the full amount of Bitcoin kind of getting released into circulation. But the way that Bitcoin's algorithm works means that the last Bitcoin's not going to get minted into existence until sometime in the 2100s. So like, not to be morbid, but everybody on this podcast, everybody listening, will all be dead before the next Bitcoin or the last Bitcoin actually enters existence. And so in this sense, right, people that are worried about like runaway money printing and all the inflation that goes alongside that in modern monetary theory, and are looking for something a little bit more like gold, right? That's scarce, and through its scarcity, it derives value. Bitcoin is very, very appealing. And I think, you can look at Bitcoin and say like, all right, those things are pretty indisputable. It is definitionally decentralized. It is definitionally scarce, and it is definitionally secure. But does that actually mean that it's worth using, worth holding? And that's where I think we get a lot of complications, because when you think about what makes for a viable currency, like the stuff that you go out and spend day in, day out, if you're thinking about like from a classical economics perspective, there are really two things that a currency is supposed to do. A currency is, first of all, supposed to be an effective store of value. And a currency is, second of all, supposed to be an effective medium of exchange. Now, a store of value means that, like, you go to your local bank branch and you take $10,000 out of the ATM and you stuff it under your mattress and you sleep on it for a year. And then a year later, you lift your mattress up and you take the cash out, and that cash is basically worth what it was the day that you stuck it under there. Right? Like, it's able to purchase more or less the same goods or services that it would have today, minus the impact, which is typically pretty de minimis, of inflation, right? So like 2 or 3%, generally speaking, that's how we think about things in the developed world. You can do that with the Canadian dollar. You can do that with the euro. Think about the equivalent in something like Bitcoin, right? Like, there is no physical Bitcoin. You can't go to an ATM and take out physical Bitcoin, but humor me for a second and pretend that you can. You take $10,000 worth of Bitcoin and shove it under your mattress, sleep on it for a year. Next year, you open up that mattress and you take out that proverbial Bitcoin, and your $10,000 could be worth $100 million, or it could be worth absolutely nothing. And then kind of everything in between. I mean, all that volatility that we've seen in the price of Bitcoin that's made it so appealing as an investment actually makes it really bad at being a currency. It is not an effective store of value. And then when you think about, what dictates an effective medium of exchange, that's just kind of like a fancy way of saying, like, look, you can use it to buy stuff. You cannot buy a latte with Bitcoin. You can't buy your house, chances are, with Bitcoin. You can't pay your rent with Bitcoin. You can't pick up your prescription at the drugstore with Bitcoin. Bitcoin is not an effective medium of exchange. And so if you sort of assess it using these two criteria, what you figure out pretty quickly is that Bitcoin is not really a currency. Even though it's called a cryptocurrency, it's not actually a currency. It functions much more like an asset. And unlike, say, a stock or a bond, right, two other good examples of like investable assets, unlike a stock or a bond, There is no underlying revenue stream, right? These aren't like companies that are selling stuff and making money. And sort of by extension, there's no associated income stream, right? There's no dividend that gets paid out by owning Bitcoin, or there's no coupon that gets clipped if you own Bitcoin. And in that sense, okay, Bitcoin now feels more like a commodity as opposed to a securitized asset like a stock or a bond. Bitcoin in this sense feels more like gold or oil or timber. No underlying revenue stream, no coupon that gets clipped. But unlike gold or oil or timber, there is no like real world physical practical application for Bitcoin. You can't eat Bitcoin, you can't build a house with Bitcoin, you can't fuel your truck up with Bitcoin. And so like I hate to say it, right? But Bitcoin is ultimately only worth what the other guy on the other side of the trade, so to speak, is willing to pay you for it. And that's a problem, because at the end of the day, and like I'm definitely something of a Bitcoin skeptic, I will put my cards on the table for this one. At the end of the day, this stuff is not worth anything. But the unfortunate reality is that has been true since the day it started, and that hasn't stopped people from getting fabulously wealthy off of it. In other words, like this stuff can keep on working until all of a sudden it doesn't. And you certainly don't want to be the guy when the music stops not sitting down. You don't want to be the guy that's left holding the bag when the whole thing kind of falls apart. But between now and then, there is nothing to say that enthusiasm and market momentum can't keep pushing the price of this thing higher. So for investors that are thinking about diversifying into crypto and into Bitcoin in particular, I always think it's like you're going to Vegas, right? It's like take that money, pretend like you're betting it all on black at the roulette table, and maybe it hits and you make a boatload, and more likely than not, it doesn't, and you lose a boatload, and you had a really fun time along the way, no matter what ends up happening. But you're not going to ruin your life and like stake your house or your kids' college education funds on this. In other words, if you're going to get into this space, really invest only what you're willing to lose completely. And if you have that mindset, then go for it. Then you figure out what your own risk tolerance is. Is it 1% of your portfolio? Is it 10% of your portfolio? I know what I'd rather do. I'd rather be on the smaller end of that range. But like some people have really intense risk appetites. But just know that whatever you're doing, this is a super, super speculative play with not a whole lot of underlying fundamentals that are supportive of what's happening with the price. And you should be pretty wary, I guess, of that dynamic.
Nice.
So, Jack, if you could comment a little bit, because to your point, you mentioned that there's a finite number of Bitcoin out there, but yet obviously there are a bunch of fund committees out there who are creating these Bitcoin funds for your regular consumers to invest in. So how does that work? And
Yeah, I mean,
what are the risks associated with that?
So you're absolutely right, Kelly. I mean, there have been a handful of pretty high profile ETF launches that happened over the course of the last 12 months that really improved investor access to Bitcoin in particular. Bitcoin is really the cryptocurrency that's benefited from this disproportionately, because previously, if you wanted to own a Bitcoin, you'd have to open up an account on one of these crypto exchanges. So like Coinbase is a good example, or Binance is another example. FTX with Sam Bankman-Fried, remember that? FTX was an example of a crypto exchange. You have to open up one of these accounts on an exchange and then go and buy the token directly on the market, right? You're buying it from somebody else that happens to have it. Now, most of these exchanges, putting FTX to the side, are pretty robust. They're pretty safe. They're pretty secure. They're pretty legit. A bunch of them are domiciled here in the U.S., so they aren't necessarily black boxes. But it does mean that you can't just like buy Bitcoin through your brokerage account. That's changed with the introduction of spot Bitcoin ETFs. This idea that through your brokerage account, you can now, not open up anything new, not give anybody else your bank account information. Just through your existing brokerage account where you're used to buying stocks and bonds and funds and whatever it happens to be, you can also get exposure to Bitcoin. That's really helped to, I would say, accelerate and fuel all the excitement that surrounds the cryptocurrency space in general. I mean, if you look at when the Bitcoin ETFs started getting launched and the price of Bitcoin, there's a pretty clear, not necessarily inflection point, but there's a point here where all of a sudden retail gets a lot more access to this stuff, and the price starts to take off in almost like a logarithmic way. Some of the stuff that I've seen recently suggests that the demand for Bitcoin that has come through these ETFs that have, again, been pretty high profile, actually outstrips the growth of supply. And when there's more demand than there is supply, prices rise, and that helps to explain again why Bitcoin has just been rallying so much over this past 12 months or so. But it doesn't change the underlying problem, right? Which, again, if you believe me, the kind of Bitcoin skeptic, all this stuff is worthless. And so it doesn't matter if you're getting it through an ETF or you're getting it directly. You, as an end investor, will at some point down the line, I can't tell you when, but at some point down the line, you will suffer the same fate. Like, it's not like being in an ETF protects you against the price of Bitcoin falling to zero. If the price of Bitcoin falls to zero, you are in just as much pain as the guy that bought it directly through a Coinbase or a Binance. The biggest difference, right, is that by buying through an asset manager and in turn buying that through your brokerage platform, you're giving yourself a few more layers of security, maybe, if you think of it this way, from like getting your account hacked or getting anything stolen from you. If you already trust your brokerage platform with your stocks and bonds and your normal kind of traditional stuff, and there's no reason you shouldn't trust them for your crypto stuff. Whereas if you've got to open up a brand new account somewhere else at a company you've never heard of before, maybe you're a little bit more worried about getting your bank account information stolen or getting some of those tokens pulled out of your account. So that, I would say, is probably the biggest net benefit for investors that are going the ETF route as opposed to going directly, is that at least perception of greater security. But the end result, as I said, is going to be, generally speaking, the same.
Great. There's been a lot of talk recently about a stable coin. Would you mind just talking a bit about that and how that looks from the environment and financial services?
Sure. Stable coins are something that have been around for probably, 6 or 7 years, maybe even a little bit longer than that. Not as long as Bitcoin, but for a decent amount of time. But only very recently, to your point, Dave, did stable coins really start to gain traction, where all of a sudden they've kind of been thrust to the forefront of the conversation about modern finance. And a stable coin is sort of boring. Like, there's not a whole lot to be said about a stable coin. A stable coin is a crypto asset, so like a token, like Bitcoin, right, that exists on a blockchain. But whereas something like Bitcoin, the price of Bitcoin is going to be dictated by market forces, the price of a stable coin is going to be pegged directly to the price of a traditional fiat currency. And most stable coins, like the overwhelming majority of stable coins, are pegged to the US dollar. And so the easiest way to think about a stable coin is that it is a digital dollar, right? So like, unlike a Bitcoin, you don't necessarily benefit from the fact that it's decentralized, because it's not, right? It's going to be tied to whatever's going on with the USD. You also don't benefit from the scarcity, because again, it's tied to what's ever going on with the USD, and the US dollar is very clearly not scarce. But you do benefit, I would say, from the underlying kind of blockchain infrastructure. And we can get to that in a moment, but the reason that stablecoins have really gained a lot of traction recently is there was some very high-profile legislation that came out of Washington earlier this year that helped to establish some a very clear framework for how to think about the stablecoin universe. We always knew that the U.S. president was going to be a little bit more crypto friendly. This is one of those expressions of that friendliness towards crypto, is really helping to legitimize the stablecoin space. And there were a few things that came out through what was called the Genius Act. It was passed, again, probably back in May of this year. Genius is an acronym, believe it or not, like GENIUS. I cannot tell you what it stands for, but Genius is good enough. Like, that's the legislation that you need to know. It set up requirements for KYC stuff. So like, Hopefully you don't get as much shady things going on underneath the surface. KYC being know your client, right? You can't issue somebody a stable coin unless you make sure that they're not, using proceeds from drug sales or arms running or whatever it happens to be. It sets up a pretty clear framework for how interest can get paid out on stable coins. And interestingly enough, it can't. So that made it very, very clear you're not allowed to pay interest on stable coins. And the perhaps most important, the big kind of landmark piece of this legislation was that it required that all stable coins are backed up 1-to-1 with dollar-like assets. And a dollar-like asset can be a dollar, right, that is held in a Federal Reserve bank account. It can also be repurchase agreements with the Federal Reserve or short-term 90-day or less treasury bills. Any one of those things functions as enough of a cash equivalent that you can use that as collateral against the stable coin that you happen to be issuing. So a lot of conversations, right, about now all this new demand for short duration treasuries in particular, as stable coins start to grow in size and popularity. And it's not a coincidence, I don't think, that the administration is keen on lowering short-term rates. We hear a lot of pressure on the Federal Reserve to cut the overnight rate. Well, the introduction of stable coins and this new regulatory framework that has that 1-to-1 reserve requirement may mean that there is more demand for this stuff, and it naturally pushes yields down anyway. So maybe the administration achieves something of a policy goal there just through stable coins. But I think the other thing that's really important, right, is to understand why, like what role stable coins can play in modern finance. And I think the easiest way to think about this is to think about the underlying infrastructure, which is blockchain, right? And blockchain is a term that gets tossed around all over the place, and not everybody necessarily understands what a blockchain is. I mean, heck, I don't fully understand what a blockchain is, but the easiest way to think about what a blockchain is that it's a database. It is a place to store information. But whereas like your traditional database, like you think about opening up a spreadsheet in Microsoft Excel, a traditional database is like rows and columns. A blockchain structures its data in blocks, and it chains those blocks together. It's really semantics for the purpose of any sort of conversation. All you got to know is a blockchain is a database. And a database can be used to store data on basically anything. And so what's become very interesting about blockchain technology is that because it's so secure, because it is decentralized, because it allows for 24-hour-a-day, 7-day constant connectivity and interaction, blockchains can be really interesting marketplaces for selling any sort of asset that you basically tokenize, in the sense that you create like a unique identifier, put it on the blockchain, and then transfer the ownership of that asset from one individual to another. Like you guys might remember a couple of years ago, there was this big craze around NFTs. Remember that? It was like the biggest thing ever. And like you looked at it and you were like, this is the dumbest thing I've ever heard about. Like, it's like monkeys with cigars and sunglasses, and like, Justin Bieber spending $2 million on this cartoon. And you're like, what the heck is this? That's not all that blockchains can support. Like that's not the only kind of asset that you can buy and sell on a blockchain. Anything can be tokenized. I mean, like the deed to your house can be tokenized. The deed to your car can be tokenized. Like the stocks that you own in your portfolio can be tokenized. Anything that has like an ownership component to it can end up on the blockchain. The reason why it doesn't, though, is because for a very long time, when you were looking to buy an asset on the blockchain, you were subject to an inordinate amount of currency risk, because you had to transact in something like Bitcoin. So the example that I would use, right, is like, let's say, you're a homeowner and you have this beautiful home and you're looking to sell it for $1 million, right? And you're doing it not the conventional way through a broker or an escrow, but you're doing it like on the bleeding edge of technology on the blockchain. So you sell your home for $2 million to the buyer on the other side of the equation, but the buyer pays for it in Bitcoin. $2 million worth of Bitcoin. The next day, that $2 million is worth $3 million because there's been some crazy headline about Bitcoin and the price goes up 50%. If you're the buyer of that house, you are really not happy that you made that transaction, right? because that $2 million is now worth $3 million. And if you had just waited one day, you could have saved yourself all this money. Now, the flip side of that, right, is you wake up the next day and your $2 million is worth 100 grand. And if you're the guy that sold that house, you're like, I can't believe I did this, right? Because like I sold it for 2 million, I thought, but now that money is actually only worth about $100,000. You have this incredible amount of security, of currency risk. That means that anybody that's serious, looking to trade serious assets like a house or a car or like a real piece of artwork, is just not going to deal with the blockchain. Stable coins have helped to change that. Because if you can now transact in effectively a digital dollar, you have zeroed out all that currency risk that used to be associated with transacting on a blockchain-based marketplace. And that, I think, really opens up the world of blockchain for some really interesting stuff, like buying assets like I talk about, like non-fungible assets like a piece of art, or a home, buying even fungible assets like securities. Like 10 years from now, will we need stock exchanges? Or can all this stuff just be done peer-to-peer through a blockchain? I mean, really interesting questions that are sort of at the very early days of something that kind of feels like science fiction. But for me, at least, I feel like for so long, the conversation around crypto was dominated by Bitcoin, kind of like what we were talking about earlier. Since the Genius Act got passed, it is now entirely dominated by stablecoins. That's what everybody's talking about right now, and some really interesting stuff to kind of like noodle on as you think about what the next chapter of financial history is going to look like. Crypto, in that sense, in the stablecoin sense, may play a pretty big role.
So that's interesting you bring that up because I think a lot of people, consumers in particular, are having trouble, even us, reconciling how, obviously, in our current currency system, let's say someone owns a bunch of Bitcoin, like how do you actually liquidate that? And how does that actually add to your net worth? Because it's such an abstract concept. You can have a lot of Bitcoin, and those who got in early have this Bitcoin that's also all of a sudden worth a ton of money. And I know there are certain areas in the world that do take Bitcoin, but to your point, there's a lot of volatility associated with that. So can you give some examples on, some successful stories and maybe some stories that weren't that successful on Bitcoin? And now the stable coins coming into play, does that mean eventually Bitcoin's going to bite the dust at some point, or what's going to happen?
Yeah, I mean, so to the second point first, Kelly, I think that's a very interesting way of thinking about it, right? If like the whole point of Bitcoin is to be the next sort of chapter of digital currency, and it's not very good at doing that, and all of a sudden here comes stable coin, which is actually very good at being a digital currency. It sacrifices some of the benefits of Bitcoin, like the scarcity, like the decentralized nature of the token, but at the end of the day, it is a digital currency. Does that like further sort of accelerate Bitcoin's demise? Frankly, I think yes. I don't know what the timetable looks like on that, but I think that stable coins and a wider spread adoption of stable coins is kind of the nail in the coffin of Bitcoin. Now, to address the first part of that question, that's a little bit tougher. I mean, I don't have a lot of stories to share with you. I actually do have my best friend from college. He's one of these guys that got in early in Bitcoin back in like 2014 and turned $10,000 into like $3 million. And the net result of that is he's like never worked a day in his life, and he lives this very bohemian lifestyle. And here I am, the market strategist. And every time we get together, I was actually just with him a couple of weeks ago. We were in Japan together on vacation. Every time we get together, we have like a serious conversation about investing and about markets. And I'm always like, you got to grow up, dude. Like you can't just have it all in one basket. You got to buy some mutual funds, like you got to be. And then here he is like laughing all the way to the bank because I've been telling him that every year for 10 years now. And Bitcoin just keeps on moving higher. And he's like, yeah, at some point it's not going to work out, but it's working out great right now. And I guess he has enough confidence that he'll be able to get ahead of that fallen knife. And like, whatever, I wish him success. But like, there are people out there that have made an extraordinary amount on Bitcoin. There are a lot of people out there that have not made a whole lot at all. Maybe a little bit, maybe something that compares to what you'd get out of a normal equity portfolio. And then there are, I'm sure, some people that have lost a whole lot of money, but that's probably more linked to like day traders, because even though Bitcoin is very volatile, if you were to look at a chart of its price, it's very clearly going up. So like you'd have to really time it poorly to have lost a lot of money. And what we found even with traditional assets is that when the market's in a big slump, people typically get more emotional. They're more tempted to go out there and sell. They're terrified. They want out. That's how you lock in those losses. And I'd imagine that there are a lot of gun shy crypto investors that get in it thinking it's only going to go up, and then it goes down 40% and they puke and they get rid of it. And those are going to be the losses. The other point that you brought up though there, Kelly, is that there are a lot of people out there with real embedded capital gains in Bitcoin, because it depends on the jurisdiction. Not every country treats gains in Bitcoin the same way. Like Germany, for example, does not tax gains on crypto. So it's not an advertisement to move to Germany if you are a big crypto guy. But like for what it's worth, a lot of the big crypto guys end up domiciling themselves over there. I think India is a similar story. The States, Canada, they treat them they treat Bitcoin a little bit more typically when it comes to taxing. But if you turn $10,000 into $1 billion, you're obviously a lot richer now than you were back then. But you also have like a $300 million tax bill that you may not necessarily want to deal with, and it's again something we see happen in public markets too. Like it's like if somebody's grandma gave them Nvidia stock 10 years ago, what that embedded capital gain looks like. Maybe they're less willing to sell out to diversify. They feel like they're being held hostage, and there is no antidote to that problem. Like the problem is a good problem because it means that you made a whole lot of money. But in the interim, one of the theories that we've heard tossed around out there is another reason why Bitcoin only goes up is that all the guys that have all these embedded capital gains in them are completely unwilling to sell because they don't want to realize those losses. And so you got almost like a captive audience in that space of people that are only buying, never selling, because they don't want to deal with the tax implications. So that longer term may be a problem too.
Wow. Always insightful, Jack. I love hearing you talk about all sorts of aspects of the economies and markets. So yeah, we really appreciate you coming on the channel here and enlightening us and hopefully our listeners and clients as to what Bitcoin is and what kind of role it can play in their financial independence.
Yeah, pleasure being here, guys. This was a lot of fun, and I hope you can do another one of these at some point.
Great. Look forward to seeing you soon.
All right, take care.
Take care.
That was a thoughtful conversation and a reminder that headline assets still require clear thinking, proper sizing, and disciplined risk management inside a real financial plan. A big thank you to Jack Manley for joining us and sharing his perspective on Bitcoin, stablecoins, and the future of digital finance. If you found this video helpful, please don't forget to like, subscribe, and share this episode. And if you'd like to see how or whether emerging assets might fit in to your retirement and wealth plan, feel free to book a time with our team at DLD Financial Group. The link is in the description below. I'm David Drummond. Thanks for watching. I'll see you in the next one.